You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome to the show, Danielle.
Hello, Jim.
Your big concern right now is the subprime loans for cars. You say it's worse than it was in the U.S. housing market after the big collapse.
Well, I don't know if it's worse, but it's exactly the same model. So, going back to my complaint about what happened in 2008 and the big meltdown and the failure to do anything constructive or deconstructive in the banking sector meant that the same players who had blown up the financial system by their packaging of subprime housing loans just went back to doing the exact same thing in the auto space and in the student loan space, but that's another slightly different tangent of this. But basically, they issued loans to anyone and everyone, and people were desperate for them because they needed to have cars to try and, some people literally living in their cars, but others were saying, listen, I can sleep in my car if I have to, but I can't drive my house to work. So I'd rather default on where I'm living, my mortgage, whatever, anything but my car loan. And because of that, people were taking loans from the shadiest lenders again, and many of the aspects or the companies who were doing, some sketchy loans before got broken off and rebranded under different names, and they bought up all these cars. So we saw a huge surge in car ownership in the past 5 years, Jim. It's been one of the, quote, bright spots. The politicians have been extolling the virtues of how wonderful the bailout of GM was because it came roaring back. But when you start looking under the hood, pardon the metaphor, you see that, in fact, there's all this junk debt in there, and that they, we were watching it, and you and I have been talking about it, them making these ridiculous terms even more ridiculous, like, zero down, extending zero interest for forever and ever, lately don't pay for 6 months. What they're finding is they've taken and packaged these debts into loans and tranches that they've now branded or have branded in the past few years as AAA bonds. So on a par with, the government, the basically North American governments, and only 2 or 3 actual corporations have that status of credit quality. And in fact, when you look inside, they're nowhere near AAA. It's all on this theory that we've split it up so much that, if a few people default or if we have to repo a few cars, it's not going to impact the quality of the bonds themselves. But it's an epidemic, so it's so widespread that it is very likely to be a big problem. And you've got many of the same culprits in there, The GM Financials is another major participant in this whole financing arm. And it all goes back to not wanting to admit that many families are on the verge of bankruptcy, basically, that people have too much debt and no savings, and that the way to heal that is to let them heal their balance sheet, not force more credit or extract, higher rates off the working poor, essentially. But people have to let a lot of these bad loans be recognized. And, those who can't afford a car, frankly, need to figure out ways to take buses to work. Or, we need to look at why people are so hard up in terms of a working wage, in terms of increasing the minimum wage to a level where people can afford to buy bus tokens to go to work, to live in a place. So anyway, yeah, that's kind of a long answer, but it is a major problem again, and it's exactly the same people and exactly the same practices, and it's just another major financial risk right now in the global system.
Well, with car loans being allowed to be paid off now over 7, 8 years, well, your car after 3 years isn't worth so much. Are people just going to be walking away from that car, leaving it in the middle of the street?
Well, it's kind of like it's back to the subprime housing stuff. So many people fell behind that the banks were literally overwhelmed and couldn't possibly, do as many foreclosures in a timely manner as were required. So people were squatting in their houses for years and years, and the banks weren't taking action. Part of that was just overwhelmed with the volume of actions that needed to take place. Part of that was also just trying to pretend and extend as long as possible. So these institutions didn't want to admit to anyone how insane and reckless they had been. So they tried to pretend like it was all good and keep selling tranches of these crazy loans. And they've been doing that lately, right? And then here you go. The central banks have been so oppressive and pushing down rates and trying to force everyone to borrow and buy more. So you've got now, every time that happened and rates moved lower, you had more desperate for income people pushing savings into these sketchy loans, trying to get something out of nothing, right? Trying to beat low rates by increasing risk. And then you've got these rating agencies calling things AAA again. Like, this is like a bad movie, Jim. We've seen this movie. You know, the last time we saw it was only 6 years ago, and yet here we are again. So it goes back to the fundamental thing that has to come out of the next big crash is that we finally sober up and realize that we have to curtail these reckless activities, or we were going to just keep replicating this disaster over and over again. And, you know, when you look at what's happening in Greece right now, Jim, you know how the new government came in, it was a week and 4 days ago in Greece, and they came in on a platform of ending the insanity of borrowing and borrowing and borrowing when you're already bankrupt. They said, listen, Greece is bankrupt. You can't loan us any more money because we can't pay you back the money you've already loaned us. So what has the ECB been doing all through this is this extend and pretend policy. Now you got a government in there who's just saying, listen, we can't continue like this. We're going to call the emperor naked here. We can't, it's a complete facade. And so he's now gone to all the, you know, they've been on this tour of of European countries, and leaders and the head finance minister of all these countries today met with Schäuble in Germany to say, listen, we need to restructure this debt. So their message is, listen, let's admit, repent, reform, and recover, right? We've got to somehow get the country out of a depression. We have to somehow get Greek people back as productive members of society. We've got a whole bunch of people that were productive workers and business owners who are now living on the street in Greece because the system has literally broken down. So what he's trying to get them to do is admit that they've made bad loans and to write off debt. That's the first step. The second step would be, once they do that, to say, and we're going to reform our government in these ways. We're going to change our spending patterns. We're going to cut excess and, downsize government expenditures. But their logic is, we can't downsize the government expenditures anymore here because of the, billions and billions of euros that have been given to the, quote, given to Greece, Jim, in the last 6 years. 90% of that went to the banks, the European banks themselves and the central banks. It didn't make its way to the people, which is why the people are destitute today. So again, the bankers keep wanting to extract fees and force debt at higher rates onto bankrupt people. And that model has run its course. And we simply have to stop that now and admit and take the write-offs of the bad debts and restructure the system.
Well, the banks in Canada now can get money at a lower rate because of the Bank of Canada cut in its prime rate, and yet credit card rates are on the way up. What's the deal there?
Well, because banks are finding that they're facing higher loan loss prospects because of all the factors we've talked about, the highest debt levels, weakening employment, lack of savings. People are financially malnourished, and so banks are looking at those prospects and saying, geez, we better, account on some more losses coming. So we need to factor in higher rates to try and compensate for that risk. Okay, that's the way a rational person looks at risk. They say we need a higher rate to compensate. So that makes some sense to me. But the problem is that central banks are now all in a currency war, right? So 15 different central banks have cut rates something like 18 different times. The Danes have done it 3 times, I think, just since the start of January, already in 15. And yet you've got global growth falling across the board. I just put a chart on today of as they are hacking down their currency to try and make their exports more competitive, every country's doing that, so no one's getting any leverage, right? No one's getting more competitive because everyone's cutting and currencies are crashing. So you have this kind of a race to the bottom. So even as prices are falling in currency adjusted terms, you're having a drop off in exports notwithstanding. So you're having a downshift in demand the world over. And it's, as I say, it's for a few factors. One, because the world's got more debt now than it had at the peak of the credit bubble bursting in 2007-8, much more debt at every level, including corporations, including governments and households. So that's a net drag. You've got an older demographic who are trying to spend less or not wanting to spend as much because they're downsizing. And you've got low yields everywhere. So you've got this low interest rate phenomenon, which is impacting the savings yields of all these people who are getting older and trying to live off their savings instead of working, right? So all these things, low wages, aging demographic, toxic debt levels, and you have these low yields on anything that pays out. And so right away you're getting a big crimp in consumption. And yet central banks are so defunct of any other idea that all they can do is try and ease further and try and ease further. Maniacally, this is just making demand weaker, right, for all those reasons. So I think why I'm so intrigued by the Greek scenario is that this could be the sort of the canary in the coal mine at long last, because right now the other stronger countries like Germany are sort of looking at the Greeks as, these wayward children and getting more and more frustrated with them. But the reality is they can't pay back those debts. And so again, this becomes the lender's problem when someone can't pay you back that scale of money. And once they restructure for Greece, which I believe they're going to have to, because there's no scenario where it makes any sense or where it's feasible to pay. So when you're faced with that fact, then surely to goodness you've hit the end of that road in terms of trying to add more credit, and you have to admit your mistakes and say we have to, restructure this. And as soon as you do that for Greece, then you're looking at that prospect coming up in other countries. And that, I think, is the thin edge of the wedge where we get to reverse this tide. And what will happen is bonds yields will spike wider in those countries to reflect the risk that they are, heavily indebted, and there's some credit risk there. Just as I'm saying that it was, prudent for credit card companies to expand their rates, it'll be prudent for the bond market to reprice several bonds and higher pricing, which means that lower pricing, which means that rates will be higher. Anyways, long story short, I think the Greek scenario is very interesting. It's very high profile at the moment, and the new finance minister there is very articulate, and he makes a lot of sense when he talks, and he talks about practical facts, about math, and about things that can't continue not continuing. So it's quite an interesting thing. Everything is going pretty much the way we thought that it would. And you have these violent swings in oil, which is, confusing some, but when you look at how much financial manipulation and trading and securitizations in that space, as we've talked about before, you see that there's these big plunges, and then there's a bunch of short covering rally, and then there's another plunge. It's a very volatile time. It's wild.
What about that gap, though, between gasoline prices and oil prices? While oil was going down in Vancouver, they upped the price of gasoline by 10 cents a liter.
Well, part of the thing is going to be that airlines, as an example, you were mentioning WestJet to me just before our call, not slashing their fares in lockstep with the decline in oil, and gas stations perhaps not cutting every time. That's typical, but they are running a business, right? And I actually think, for example, when it comes to airlines notoriously lose money a lot of the time. So if they're in a phase now where they're getting better pricing because the fuel prices have plunged, it might be prudent for them to not cut their airfares, to not engage in a race to the bottom of competition against providers for the cheapest fares, because the truth is that at some point those prices aren't going to drop anymore, and they may indeed climb again at some point, and they need to build in some profit buffer for the rainy days ahead, right? Just like as we were talking about with Alberta, how the mistake of the boom is that people overspend and don't set aside enough of the excess profit to see them through the downturn or the weak period of earnings. And if you're, cutting all your prices right now, you may find that you're back to, barely making it on a profit scenario in another period ahead. So you really should smooth out your earnings cycle, right? By setting aside savings during the period where you're making some extra margin, and then drawing down that extra margin in periods when you have financial challenge. So I think that's possibly what maybe the gas stations are trying to do, is they're realizing, wow, prices have dropped a lot, and, Jim, demand is weaker across the board. Again, you'd think that just on a pure price decline, everyone would say, wow, well, everyone must be consuming more. But actually, that's not what we're seeing, right? Not just on a global export demand scenario where you're not seeing that weaker currencies are reviving demand, you're not seeing it in the domestic economy either. So people, when they save a few dollars on gas, that's great, but they have tons of places that's already spoken for that capital, like debt payments, right? Like food, like housing, like rents that are up. Like in Canada, housing costs and property taxes are very high. So all that sucks away any added benefit that you might think they would be, quote, spending somewhere else or traveling more. Not necessarily.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. The European Union has upped their economic forecast for the year, saying lower oil prices are the reason for that. Is that a good reason for optimism?
Well, I don't really think, maybe, as I've just said, lower oil prices may help consumers to service their debts and spend on some other things. But generally speaking, I think what they're really hoping is that a weaker euro is going to stimulate exports. If you listen to every one of these governments, they're pretty much all saying the same thing today, which is we believe that a weaker currency, Canada's saying a similar thing, we believe a weaker currency is going to help drive exports, and we therefore are more optimistic about our growth, perhaps, looking forward. But I think that they're also notoriously horrible at forecasting that stuff. They basically never see downturns coming, so they're always on the optimistic side. And if you look at global forecasts for 2015, they were quite optimistic coming into the year, and as the first quarter data hits, for example, the data today on the U.S. trade deficit in Q4 soared because of the U.S. dollar strength, and that hurt exports. So that's now likely to take about a 0.5 off of previous growth estimates. So I think that kind of stuff's going to ratchet down growth forecasts that were rosy coming into 15. With every passing week here, we're getting reason to question whether those are going to be over optimistic again this year. And I think that's probably going to continue.
The Bank of Canada making noises again about cutting its rate any further. The last time they did that, the loonie dropped by 2 cents. Is that what they're really hoping for? A loonie that's worth nothing?
Well, again, competitive devaluation is the key theme. It's the go-to idea of governments across the world today. So yes, I think they are interested in trying to have a weaker currency because they're looking for someone to buy our exports as a way of supporting our economy since the domestic consumer is so indebted. So I think they're quite happy to see a weaker currency at this point. The trouble is that we're trading with the price of oil almost in lockstep, right? The currency has come off exactly with the price of oil since last June. So, for example, today, it's been a very manic week indeed. You had a big plunge in the price of oil and the currency. I think it was maybe Monday, and then you had a big rally the next day, then you had a plunge again yesterday, and you've had almost the same commensurate recovery this day. So the volatility in currency markets and in the price of oil is very highly correlated, and it's really hard for people to make adjustments to this kind of thing. You know, up and down 5 and 6% day after day is very hard to factor into any business model, and stability it is not, right? So I think it's quite unnerving. I wouldn't be surprised if the Bank of Canada cuts further. As I said, the Danish central bank has cut rates 3 times in the last month. I mean, you know, everyone's basically trying to somehow, some way, get their economy some sales here.
Are these cuts fueling a real estate market that many said was too hot in the first place?
Well, it'll be interesting to see at what point low rates don't have a reciprocal impact on demand again. So this is the relationship that we're noting, as I've said, on a bunch of levels here, that lower prices are not stimulating more demand. And I think at the point of exhaustion on rates, because Canadians have taken on debt so excessively in the past few years, and because people have already traded up, and we've had, you know, soaring house markets for so many months now, so many years of months, at some point I think lower rates don't necessarily stimulate more purchases. Now maybe people will try and refi, but many people, you know, already had either floating rate mortgages or had already taken advantage of low rates to refi in the past few years. So I'm not sure that you're going to see much impact on demand, because the other thing is, don't forget, as we've discussed before, the hot demand areas tended to be in the west, right, where you had tons of demand coming courtesy of the oil patch, which is now in extreme reversion, as we've seen. So you're seeing a drop in the demand, the buyers interested in those previously hot areas. That'll feed back into the Toronto sector, the Toronto market via the finance sector, which will also see some cutbacks going into this slow growth phase. And so I don't, again, think that lower rates will necessarily stimulate much in the housing market at this point, but we'll see.
Danielle, thanks a lot for chatting with us.
Hey, my pleasure.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net, or you can check out our popular YouTube channel, Talk Digital Network. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.